All right, so we're going to talk about those returns. This is a part of the presentation, but this is the one I felt was most important for you guys. So we talked about net operating income already. We're going to minus that debt service out of the net operating income, and we're going to have our cash flow. Everybody's pretty familiar with cash flow. You got a property, $400,000, you put 20% down, you got $2,000 PITI. So right now your rental revenue is going to be $2,500 a month, and I'm not going to go into expenses. I'm just doing this for the example. There would be other expenses here. But you got $500 times 12. That $500 is how much money you're making every month from cash flow. Everybody with me on that? So that's $6,000 a year. So my 20% down was $80,000. So I take the $6,000 I'm making in cash flow and I divide it into $80,000. And that gave me a return of 7.5%. Now remember from our previous conversation, our goal is 15%. So really I'm only halfway there with the rental. That kind of sucks, right? I'm only halfway there. That's all the money I can make. What are we going to do to get our 15%? Because we need to retire someday, right? Well, there's another form of return on investment. This you get from debt paydown. So if you're familiar with this, this is an amortization table put on a chart, okay? And what it basically is, the red is the balance. You start paying your loan goes down. This is your interest in yellow. So in the beginning, most of your payment is interest, and it decreases the amount of interest and increases the amount of payment over time. Does that make sense? Everybody follow that concept? A lot easier to understand the concept if you put it visual, isn't it? By the way, that's true for your clients too. Even though you know this very well because you're familiar with it, it's still a hard concept to get across unless you show it. Okay? All right, so in the beginning, you've got $461 out of your 2011 payment going towards principal and $1,066 going towards interest. All right? So your tenant is paying down your principal for you at a rate of $5,532 a year. That's pretty cool. What did we have to do in order to get that tenant to give us equity basically in our property of $5,532 a year? Well, we had to put $80,000 down for the down payment. So our investment was $80,000. Our return on investment was $5,532. So we have 6.91% return on investment. Everybody with me? The other slide, we had, 7.5% return on investment? Now we're up to 14% return on investment. We're getting closer to that 15 number, right? Here's the second one, expenses from deductions. So we have these expenses that go out of our payment. Part of it's interest. We have property taxes. We have insurance. Those are all built into the payment. There are additional expenses, most likely, but we're not going to talk about those right now. For the simplicity of the conversation, I'm just going after those. Now, I also went over and asked my client what kind of income he made. I didn't have to be a tax expert to look at a chart and see that his income is on this range and he's in a 24% tax bracket. Okay? I didn't break any tax laws. I'm not really giving tax advice. And every time I say this, I'll tell him to check with his tax advisor. Okay? But for the sake of the example, I can see that if he gets $18,600 worth of deductible items in his tax return, then he multiplies that by 24%, and that's the real number of what it's worth to him. Everybody understand that $1 in deduction is not worth $1. $1 in deduction is worth only the amount that you would have paid percentage-wise in income tax. Okay? So by the way, you have to have income in order for this to be valuable to you. If you're insolvent, this isn't going to help you. Okay? Don't laugh. You're going to be surprised. Because you can be really insolvent on paper and not in real life. A lot of self-employed people spend a lot of their time, including us real estate agents, writing everything off and we have no income. Well, that might affect you if you don't have income to take your deductions against. Okay? So 4464, same kind of thing. You recognize now that's the return. This is the investment. Now you got another 5% return. Depreciation. This is a biggie. All right? And I can see James back there nodding his head because he remembers this because he owns those properties and he's depreciating all of them. Depreciation is the biggest difference where you'll see a paper loss even though you're really making money. Okay? The business world really goes around on depreciation. It drives a lot of decisions in real estate. Okay, this depreciation schedule for residential property. Remember, anything from between 1 and 4 units. Residential property is 27.5 years. In this case, being shorter is better than being longer. The commercial depreciation schedule is 39 years. Okay? So you got your house price was $400,000. We're talking about a single family. You take out the value of the land. Most of the time you can see that number right on the tax return if you've never used it before, but it's usually right there. The value of the land is less than the house of the price. Most of the time I usually find that it's 30% off. The land makes up about 30% of the improved value. Okay? So I take that number, the 280, bring it down over here, divide it by 27.5, means that that's worth a $10,181 depreciation deduction. Okay? So by the way, I get that every year. So that's pretty cool. Until I've used up the 27.5. So that's 10,181. There's my 24%, and now I've got the 2443 as my value. So there's my 2443, and again, it cost me $80,000 to get it. So I get another 3% return on investment. Everybody good with that? All right, so here's my ROI stack. See this big one? By the way, that's supposed to be $1 million. I'm pretty sure it is. So that's what it looks like. So if you ever want to carry it, remember to bring a big suitcase. Okay? Won't go in a backpack most of the time. Cash flow, 7.5%. Debt paydown gave me 6.91. Deductions gave me another 5.58. Depreciation gave me 3.05. So even without adding in appreciation, which is the biggest one, I'm already at 23% with zero price appreciation. Everybody good with that? Now you're starting to understand why it's good to invest in real estate long term. When you really get an understanding of it, you can pass that understanding to others. When you really believe it, they'll really believe it, right? So that's what it is, 23% without even going to appreciation. Appreciation blows this number out of the water. Appreciation winds up being so good it's hard to believe, okay? So with appreciation, $400,000 property, could you guys see a 4% appreciation rate? Could you see that property next year being worth $16,000? I could. Matter of fact, for the last 8 years, it's been 15%, not 4%, right? So the power of leverage, you only put down 20% on that property most likely, and you got to leverage it for, 25% if you got a better rate. Most investors, a lot of times, are now switching to 25%. So you're here, you got that gave you a 20% return. Okay, everybody good with that? We already had a 23 plus this 20. We just got a 40% return on our money. You hear anybody in the stock market giving you a 40% return on the money? Nope. Not going to happen.